Thanks for having me again, Abu. I really appreciate it. As you know, I love talking about valuation. It was something that I came across a number of years ago in my career and just sort of fell in love with it and kind of did the education and then build up on it and continue to practice it today. So today we're going to be talking about, in particular, unlocking value. So the art of business valuation. And you see art in there, art of business. It's really kind of a mixture of, it's more of a craft, right? There's some art, some science, um, but people typically, kind of refer to it as the art of business valuation. So, quick agenda, brief introduction and overview. What is business valuation? What are we trying to accomplish? How do we unlock value? And going through the process of a business valuation kind of gives us a sense of the different sort of ways of unlocking value. The technical sort of approaches to to business value itself, and then we'll talk about discount rates and go through a fairly comprehensive example, and then questions and answers. So just a little bit about me. I'm a finance professional. I've been, practicing finance for just over 20 years. Currently a CFO and corporate secretary at a critical minerals company. So having fun with that. And during my career, much of it, as you can see, was spent in the retail industry. So fairly large companies, the second largest grocer in Canada I worked for about 12 years. I also do business valuations with a boutique firm in my local area in Toronto. Studied at York University, did a BA in economics, and then also did some professional designations. One of them focused on accounting, so CMA, and then the other two focused on business valuation. So, the definition of what a business valuation is it's really kind of a set of procedures that we use to determine what the economic value of share capital in the company is, or what we refer to as a business. And we typically do this. I mean, there are multiple ways of valuing that interest, but we typically start with the whole company, so what we call the enterprise value. So a company is funded either through two ways. It's debt or equity. So we kind of look at the whole thing, including debt and equity. And then normally what people are interested in is obviously the equity value. So we strip out the debt and what we call redundant assets. So assets that are not critical to the core operation of the business. So businesses may have artwork or, luxury vehicles, not necessarily core to operating the business. So that's what we call redundant assets. But so equity value equals enterprise value minus the debt and any other non-core assets. As far as what that standard of value is, people normally hear the term fair market value, and that's sort of within our professional standards, the standard of value that we're dealing with. And I've got a long definition of it, but essentially it's really two parties that are coming together. They're both willing and able to transact. They're at an arm's length, so they're not a related party. It's an unrestricted market, and they're not under any compulsion to buy or sell. And they both have reasonable knowledge of the relevant facts. Abu, you had a question, hands up?
Yeah, a question on the previous slide. So you mentioned enterprise value. Typically, do we consider that as more tangible as opposed to intangible, or are we getting there? Am I ahead of?
We're gonna get there,
Okay.
but it would include intangible as well. And you'll kind of see where we reconcile those two items. But great question. And so this fair market value is really kind of the cornerstone of business valuation theory. So in a very sort of, a picture is always a great way to describe this thing. It's, fair market value is really the intersection of where a buyer and seller come together and agree on what the value of the asset in question is, or the equity value in question. Common situations that require evaluation. There's quite a few here. This is obviously not a comprehensive list, but there's quite a bit here. A lot of it is around income tax transactions and estate planning. So you want to pass on a business to a family member. There could be shareholder disputes where one party wants to buy out another, or they want to cease their business relationship. Matrimonial law matters, couples having a divorce, one or both are running or own a business. There's separation of those assets. ESOP, so employee share ownership plans, also require valuations. When you look at like goodwill impairment, purchase price allocations, those kind of go together. A company has purchased another company and there could be goodwill associated with it. And for goodwill impairment, we test the assumption that the goodwill is not impaired, so the value is as it was determined when it was acquired. So that testing usually needs to happen at a minimum on an annual basis, and that's more internal financial reporting. And purchase price allocations are really saying, okay, we bought this business. Here's how we identify and separate various assets, both tangible and intangible, and record them on the financial statements. M&A is a big area, expropriations, fairness opinions. So if a company is going to acquire another company, you typically see this in the public company space, where the board has a fiduciary requirement to have an independent party do a fairness opinion. And it's a fairness from a financial perspective. So they'll opine on whether the company's either paying a fair price, overpaying, or underpaying. And then a lot of it you'll see in going public or going private transactions where a value will be assessed, and that may give rise to an IPO price, or we want to take the company private. What's that buyout look like? So really kind of core principles around valuation really kind of fall on three sort of what I call pillars: cash flow, growth, and risk. That drives value. In any business, obviously you want to maximize cash flow. You want to grow, and growth is a big determinant of what value is, but not all growth is equal. There is, good growth that creates value, but there is also value destroying growth. And when we get to sort of looking at your cost of capital, so if your cost of capital is 10%, and the return that you're going to get from doing an initiative is less than that, then you'll actually be destroying value because it's less than your cost of capital. And then risk. And risk comes in many different factors, which we'll kind of go through. But that also plays a significant influence on determining the value of a business. When we look at, core principles of valuation, it's determined at a specific point in time. So when we're valuing an asset or a business, we will choose what we call a valuation date. So as at this point in time, here's what we believe the company is worth. And we'll really kind of look at it from, what's knowable or known at that point in time. Information changes over time. As you keep moving forward in time, you have more information. But you really have to draw a line in the sand and say, at this point in time, here's what we know, and this is what we value the business at. It's perspective. So we're really kind of looking at the future benefits that are attached to it. So when we look at various approaches around discounted cash flows, which look in are more forward looking, that's where it kind of touches upon that future benefit. Abu, question?
Yeah, just on cost of capital, is there like a baseline or a defined standard lead in best practice or lead in practice on what that should be, or is that dependent on the industry, dependent on what you just mentioned, which is
Yeah,
yeah.
you're there. There really isn't. There's an approach to determining what that is, and we typically use what we call WACC, weighted average cost of capital, and it's a buildup. And I'll actually walk you through what that buildup looks like. but there are various components, but you're absolutely right. It does consider things like industry, size of the company, what we're seeing from a very what we call risk-free rate. So, maybe a treasury bond, and we build up from those perspectives. When we look at WACC, we also consider the cost of debt as well. So it's weighted between debt and equity. But we'll walk through an example and I'll show you exactly how that works. So, and to your point on cost of capital, the market dictates the appropriate rate of return. So that's really that cost of capital is really a proxy, a sort of a minimum return of capital. That's what it's really there to represent. Another key point is when we talk about intangibles and tangibles, when we look at the value of a business, the higher that net tangible asset value is, the higher the going concern value. So the net tangible asset is really taking the balance sheet and revaluing it to its fair market value, but looking at the tangible items that are on there. Your going concern, when you're looking at it from a cash flow perspective, should be higher than that, and that gap really tells you whether there's intangibles. So it's really, the higher your net tangible asset value is, the higher your going concern value will likely be. So there is also, it's influenced by liquidity. So, something that is easy to liquidate or to sell will have generally higher value than something that is not liquid. So a private company, when we build up the discount rates, we also look at, in some cases, if you're not buying the whole business, we'll look at discounts for liquidity. So it ends up, you penalize the company a bit for the fact that you can't just turn around and sell a private business, I purchased this and I made a mistake. I want to unwind and sell it tomorrow. Not likely going to happen. So that liquidity really drives value, and it reduces the value of the business for the equity, because you cannot liquidate it very quickly. Value is taken to be the present value of future benefits. So we sort of talked about that. And in this case, it's really around, goodwill and commercial value. There's also value to the owner. So if you're the owner of a business, the value of the business to you may differ from what that value is on a commercial basis to someone else. And then lastly, the value of a minority interest. So we kind of talk about that with the liquidity as well. If you're a minority holder, so you hold less than 50%, then your shares may be worth less on a per share basis than on a pro rata. So you don't control the direction of the company, you don't control the decisions that are made, so that decreases value. That has an impact on value. So unlocking value.
All right, Vince, before we get in, I just want to pause for a second to ask. I know we only have one participant, however.
No, it's okay.
Alex, do you have any? Oh, Alex, do you have any questions?
Oh, I'm just following along. I've actually, I work in corporate finance, so I haven't actually done a valuation, but obviously the business school experience, I took an M&A course at business school, and so I'm I'm kind of following along. I think one question I had was around the non-commercial aspect, the value of the owner. Like, what's the best way to think about that component of it? I follow the discounted cash flow, use a terminal value to try to figure out kind of like what net present value is of the acquisition, but the non-commercial piece is kind of tricky for me.
Yeah, we kind of look at it from the perspective of, you may be a sole proprietor or someone that is running it on its own, and that value to you, like it's more personal goodwill as opposed to commercial goodwill, right? Like if you leave the business, really the business is you can't run it outside of that one key person that you have. Whereas where there's commercial value, there are processes in place, And the business can really kind of stand on its own. So that's when we're really kind of talking about those two components of commercial value versus non-commercial. What's that worth to the owner and
So,
the income derived.
okay, great, thanks. So is it more kind of subjective towards the owner of the business? Is that safe to say, or?
Yeah, there is some fluidity in it. It could be a bit more subjective. It's at times hard to quantify. It really kind of depends on the business itself, and what the nature of the operations are and how that, call it, key person sort of fits in,
Okay,
well operation.
okay.
So we also have Jewel on the line. Before I get to Jewel, I want to kind of carry on Alex's point. So there are situations, I believe, Vince, correct me if I'm wrong. Again, I'm new to this as well, where is there a value put on certain, like the C levels in organizations to kind of determine the actual valuation of an organization? So if I give you an example.
Yeah.
All the conversations today around open AI has to do with the cadre of the C-suites and their expertise, given that some of the expertise is, hard to find on the market. So when you
Right.
look at the valuation of the organization, you also kind of put in that technical competency of the C-suite. Is that also a determining factor in terms of valuation?
When you're looking at it from a more intangible perspective, so we have some tools where we try and determine what that intangible value is. And for example, there are tools to value the workforce. So how does the workforce contribute to generating cash flows? It's a contributing cash flow sort of component. It's not, I mean, it's a tough area to really pinpoint, okay, what's this C-suite really sort of adding from a value perspective? You've kind of had to look at it from two perspectives where, can you really measure, you can measure the effectiveness of a management team, but having it, seeing it in a very sort of, I guess, clear way of, well, here's how a management team ran it, and here are the cash flows that generated from team A versus team B. That's difficult to see, when you're looking at one point in time, because the management team you have is the management team you have. So you try and assess the quality of management based on the cash flows it generates, because that's really what it comes down to. But it may be tough to really earmark and quantify what that is. It's not like saying my brand is worth X because I can generate more margin, and you can measure that. Coca-Cola versus a no-name brand. There you can assess the difference in margin and what that brand is driving, and that's really its intangible value. A management team, I think it's a little bit more fluid than that, and maybe a bit more difficult to put a number to it. That's where it's tough.
All right, thank you.
I would
Joel,
think
any?
one
Go
thing you
ahead.
could do to approach this situation is, I guess, evaluate the quality of the management and then understand kind of like what synergies you expect to generate once you acquire the business. And
Yeah.
if you really believe that they can actually, you've got the right team in place to be able to unlock the value that you expect down the road. And to your point, there's probably like some KPIs around return on investment,
Right.
returns on assets, returns on equity, returns on invested capital, to understand kind of how well they're been performing in the current state, to assess, figure out where they could potentially be.
Yeah, no, and that's a great point, Alex, is yeah, you have those sorts of tools where you can assess from that perspective, but yeah, it's a little bit it's a fluid sort of look at it, but there are ways to kind of assess what that may be.
Okay, thank you. Joel, any questions from you?
No, Vince, just happy to have you here. Thank you.
All right, thank you.
Thanks for coming, Joel.
All
Appreciate
right,
it.
Vince. Thank you.
Thank you. So unlocking value. So I moved this up in the presentation from the last time because I think it's an important part to kind of really look at. And when you get back to, you know, the three pillars where we talk about cash flow, growth, and risk, what we've kind of got here on the list are things that ultimately influence one, or if not all three of those key items. So processes and procedures. You know, typically when you're valuing a smaller company, they may not have the resources to really focus on getting, you know, standard operating procedures and processes in place. But it's really important around managing, you know, risk in particular, is having set procedures and processes and internal controls. And that also, you know, ultimately, in my mind, influences cash flows and growth. So, you know, getting a really good sense of nailing down processes, having your business operate at a level with, you know, with that level of discipline and rigor goes a long way. Key performance indicators, you know, having benchmarks, measuring, how are we performing? Where can we improve? How do we drive more out of the business? Again, hits all three sort of pillars. Risk assessments, understanding what are some of the risk elements within the business, and really it's more having, you know, those top of mind, always assessing and always addressing where the risks are and how you're going to mitigate them. How you're allocating capital. So if you wanted to buy, you know, new equipment, or there's a project, you know, doing the assessment to understand what sort of returns are you expecting. Are those returns going to be greater than your cost of capital? Well, that's going to affect, you know, growth. You're managing risk, and ultimately translates into cash flows. Having a good budgeting and forecasting process, very important. You know, I came from very large organizations, so this is, you know, was our bread and butter. You know, we spent a lot of time forecasting and budgeting, and they're control tools as well. In smaller companies, you may not see that, but you know, not that it's not there, but when you do see it, you get a really good sense of, you know, this business owner team really understands and is controlling their business. Cash flow management, really kind of the same thing, understanding that cash conversion cycle, getting a hold of, you know, a foothold of working capital and managing that effectively is important. Talent development. I mean, I think we've all probably been in situations where, you know, it may not be top of mind, but it's so important. And you really see it when key people leave the business, and the business is sort of struggling on, well, you know, we didn't really think of employee retention or developing the talent that we had, or how do we, you know, keep them or even attract talent, which is tough, and can have a significant impact on the business. Financial reporting, I mean, you see the whole spectrum of, you know, companies that are really good at churning out timely and accurate financial reports, to, you know, the other end of the spectrum where it's not a big priority for them. And that's a problem. If you can't measure where you are today and have accurate reporting, you can't make, you know, informed and effective decisions, and it just trickles through the business. Shareholder agreements are super important as well. You know, having a very clear agreement, and some of these agreements can also speak to buyout clauses. So, you know, if there are shareholders who want to leave the business, it really reduces the amount of tension and ambiguity around, well, how do we actually divvy value here, and have we agreed ahead of time on what that value measurement is going to be? Abu, you had a question?
Actually, Jill has a question.
You have a question? This is fantastic. By the way, Vince, just awesome. You know, I love just how good the information, but how simple you've made it to just digest. Makes a world of a difference. Thank you for that.
Thank
someone
you.
like me, that's just, you know, there's a skill in that. So I just want to name that. In
Thank
terms
you.
of, I think the thing that was coming to mind is, yeah, like, let's say on private equity side. So is my guess is this is par for the course in looking at buying certain organizations, is you're going to get the valuation. And of course, and you're going to run through all of these steps. Is that kind of I mean, I imagine that, I don't know your specialty in terms of, company size or industry and things like that, but is that kind of what some folks that are doing valuations do? They might work with PE firms and kind of be in-house and say, well, we're looking at this company, this company, this company, this company. We need our own internal numbers on what's going on here with all these different metrics. Is that kind of where this type of a role could fit in? Is that? Yeah, I'll stop there.
No. It's a great question, and absolutely right. Like, and it really kind of comes back to, why are you doing the valuation? I'd say in the perspective of, let's say, PE looking at a firm, you don't just want it to be a math exercise. You're really kind of assessing the company. You've got to look at these elements in my mind, and if I'm doing a valuation report, even not from a private equity perspective or an acquisition perspective, I need to consider these items if I'm taking a holistic view of the company and trying to assess, in particular what that risk is. And in addition to, well, what are the growth prospects, right? So we look at the industry and we do that industry analysis and overview, but we also have to step back and say, well, we've got the numbers and we're looking at it, but what's the overall story? How do these things sort of fit into assessing the risk level, the future opportunities for the business? So I think in all cases, if you're valuing a company, I mean, we look at it from this perspective and we consider many, if not all of these things. I would think if you're doing acquisitions and it's a core part of your business, that yeah, you want to be delving, behind the curtain to really take a close look at this stuff. Some of it will be apparent, like financial reporting. You're going to get financials and they're either going to look bad or they're going to look good, and you can tell pretty quickly just by a few questions on give me the support for these line items versus talent development. That's going to take more digging. That's going to take more conversation with the management team, and those are more probing sort of questions to find out. But great question overall. Yeah, you're looking at everything.
Yeah, Vince, it seems to me that, private equity firms are very focused on, when they look at evaluating investment, they're going to evaluate the strategy, the operations, and the people, because in this, because they see maybe a distressed asset that has an opportunity for them to like really improve it fairly quickly for them to turn it around and sell. So their time horizon might be a lot shorter than, say, a company buying another, competitor or in the space that they're maybe trying to round out their portfolio strategy as well, acquire some new capabilities or access to new markets, or expand their product offerings, those types of like things. And of course, they're being judged, by the market, if it's a publicly traded company, whether or not that actual acquisition is going to add value. They're going to they have a scorecard, which is a stock price, whereas a private equity firm may not necessarily have that uh public, public facing scorecard per se.
Yeah, and I think your point on time horizon is really spot on, because from private equity, I'm assuming the time horizon could 3 to 5 years is generally what we hear out there, as opposed to another company that's doing a tuck-in acquisition where it's they're not going to be divesting it in 3 to 5 years. This is kind of we're bringing it into the business, and we want to make sure from an integration perspective this makes sense. So yeah, those are excellent points, Alex. Thank you.
Vince, I just had a question on insurance. So I was chatting about it a couple of weeks ago with a lady who does private equity M&A, but her specialty is M&A insurance. What is that?
So I've heard of insurance around reps and warranties during M&A transactions.
Okay.
Where if I'm selling my business and I'm putting a data room together. And, I'm also, as part of the agreement, representing that everything that I've kind of put forward is true and accurate, and I'm not misstating anything. But there are insurance policies behind that in the event that something is missed or there's an oversight, where the acquirer would have some sort of recourse. So I've heard of it in those terms around reps and warranties, insurance, for M&A transactions. Because, there could be significant financial penalties around that if it was deemed that someone was misrepresenting, or, something goes sideways from a reps and warranties perspective. So just, on the unlocking value, strategic planning, we talked about insurance briefly. Obviously, debt management, you don't want to be too over, you have to be able to service the debt, and it's got to be strategic in nature as it's helping you grow. And margin expansion, are there other product or service lines that have the ability to drive incremental margin on? Is there a promotional strategy? Margin expansion's a pretty wide area, but you can also look at it from cost structure as well. Is the cost structure of the business optimal? Some of the organizations I've been in the past, we've focused a lot on cost because there's so much waste, and as an organization gets bigger, there's so many different areas where costs kind of creep in and you lose sight of them. But having people dedicated to looking at that, it's an opportunity. It won't save you, but keeping costs in check is always important. So valuation approaches and methods. So here's where we kind of get back into the mechanics and theory of it. So, we really look at, valuing a business either on a going concern value, so it's going to continue to operate for the foreseeable future, or a liquidation value. Our presentation is going to really kind of focus on that going concern, but a liquidation is more of an asset-based approach where we'll revalue the balance sheet based on, we'll reset everything to fair market value, because the balance sheet is typically recorded on a historic cost basis. As far as going concern, we have three really key approaches. One is the income approach, market, and an asset approach. You can also use the asset approach for liquidation as well. With the income approach, we're really kind of looking at the business's ability to generate income and cash flows in the future. So the techniques that you've probably seen and heard of, discounted cash flow is a key one. So it's based on forecasted cash flow, so it's very forward-looking. Capitalization of earnings is based on normalized historical earnings. So we'll look at, let's say the last 5 years and maybe weight those years more towards the most current years. And that's really if the business is very stable, mature business. And capitalization and cash flows is the same approach. It's just looking at cash flows instead of earnings. So, the DCF is really kind of used if you've got a period of let's high or unstable growth, but it will, let's say, normalize in 5 to 10 years. Then you'd want to capture in the DCF, well, what do those first 5 years of higher abnormal growth look like? And then we add on a terminal value to say, well, here's sort of normalized in perpetuity what those cash flows look like. With the market approach, we're really, using a comparable company analysis. And there are two approaches: a comparable company analysis, and we'll look at precedent transaction. But from a comparable company analysis, we're leveraging market data. So we're looking at, similar public companies in the same or similar industry. This approach is used a lot in M&A and investment banking. It can sometimes be challenging to find, similar publicly traded companies. So it's although it seems like it's an easier approach, it's not really. Like there's quite a bit of work that needs to go into really kind of find, well, what's similar, and then you can also look at data to help normalize and really get a true benchmark. And in a lot of cases, what we do is we look at valuation multiples like price to earnings, EV to EBITDA, or price to sales, and use those as a proxy to get what that comparable is, and apply that to those metrics of our subject company. And we typically use a range. So, the tendency is to want to kind of pinpoint, well, it's, 5 times EBITDA, but we will derive a range and sort of benchmark what that is to adjust for any differences. The other one that within the market approach is precedent transactions. So this is really kind of looking at private transactions of similar companies that have been sold. So it's similar to the comparable company analysis in the fact that we're trying to find similar companies, and these are typically private sales. So we use a lot of databases that are out there. S&P Capital IQ has a lot of information, Deal Stats, FactSet, where they're collecting, data from M&A advisors, business brokers of private transactions that were not out in the public sphere of the market. And we're using the same similar valuation metrics, price to sales, EV to EBITDA, to say, okay, well, a restaurant that's of X size that serves, let's, say it's a particular type of food or offering would trade at, 4 times EV to EBITDA. So we'd use those sort of value metrics to get what that value is for that subject company. So it's really kind of using precedent transactions, so private transactions, or public company comp data. For the asset approach, similar to what I mentioned earlier, we sort of really take the balance sheet and revalue each line item to fair value. It's predominantly used in the liquidation approach. That's the key approach, but we also use it in the going concern to really kind of get a sense of, well, how much intangible or goodwill value is here. We haven't pinpointed exactly what those components of the intangible value is, but we've assessed, here's generally what we believe the good value or the intangible value is in the business if we compare it to the going concern. So discount rates. So when Abu, question?
So I think the last time I'd asked the question, do you simply use one approach or do you use a multiple of approaches? And I believe the response was you use a multiple of approaches. But going back to Jules' question on PE, I would assume that the previous slide that you showed, the precedent transaction analysis would be more on the PE side. Am I correct in assuming that?
It could be data from private equity transactions. Yes.
Okay.
Yeah.
All right. So would you use this
collected
approach
across the board?
Okay.
So a company like Deal Stats,
right.
If you are a business broker or you're an M&A firm, or involved in those transactions, you can actually submit transactional data to them. I think you get free access to their tool if you do that. So it encourages companies to submit that data, and then it obviously helps support this sort of analysis when you have these comprehensive databases.
But would you use just a singular approach, or would you use a market and an asset approach through your evaluation?
So when I do evaluation, I'm really looking at all three. I'm doing an income approach. I'm looking at market to test my income approach. I'm also doing the asset approach to say, okay, well, here's my net tangible assets. Here's the income approach, and that delta will give me a sense of what that intangible value is. I may not know exactly what components of the intangible value is, but I know that there's an intangible value there. So I'm really looking at all three. That helps you triangulate value. And then in some approaches, you can take a weighted average of each. There are definitely approaches where They'll use the market approach. It'll give you X, and you can weight what an income approach using cash flows gives you, a market approach. So you're really kind of using a combination of them.
Thank you.
You're welcome. So discount rates. So we look at it from the perspective, and Abu, this will kind of address your question earlier, where we're kind of looking at WACC and how we build this up. So discount rates, we apply it to a series of cash flows, whereas the capitalization rate is really applied to a point estimate. And the difference is, whether there's a growth factor applied or not. And you'll see this come into play as we walk through the example and how we build this up. But it's really kind of, giving you, here's a baseline rate of return that we need on capital. We don't want to be purchasing items. Well, if we're looking at it from a project perspective, we don't want to be doing projects that give us rate of returns that are less than our cost of capital, because then we're just destroying value. Whereas, when we're investing in a business or something that's going to generate cash flows, we want to make sure that we're at least getting our market level rate of return back. And obviously, above that would be great.
So Vince, so a cap rate, is that just a perpetuity?
Yes.
Okay, that's what I thought.
Yep.
Okay.
So when we look at WACC, this is, and there's a couple different ways that you could use the capital asset pricing for getting cost of equity and all those things. But we typically use a build-up approach where we're building it up component by component. So, our long-term bond yield, we're saying, well, here's a risk-free rate. We're starting with that. We're putting in an equity risk premium. So what's that premium that, the, I guess, marginal investor would look at as, the incremental return they would want for investing in a stock or a company, as opposed to, just investing in a risk-free asset. There are other premiums like size premiums. So a lot of the data we look at, returns may be influenced based on the size of the company. And when we're looking at some of these databases, they break it into deciles. So smaller companies, typically you're going to require a higher return because there is more risk involved with those. An industry risk premium really sort of captures a particular risk profile of an industry. And company risk premiums is where there's a little bit more ambiguity and a little bit more what we call professional judgment in it. So when we look at company risk premium, we'll look at specific attributes of a company and assess, well, do we need to consider, forecast risk? Are there other risks that are unique to that company that we believe are not captured in, let's say, the industry or the size premium or any other discount rate that we're including in here? So then we get a cost of equity, and we'll look at, from a weighting perspective, based on the profile of the company and just sort of the industry makeup, how are our companies capitalized? Is it typically 75 equity, 25 debt? We'll kind of look at what that market weighting is and assess it there. And then our cost of long-term debt could be, typically it's, prime +2 or prime +2.5. It's a market rate. It really kind of depends on the company and what that market rate of debt is. And then, the reciprocal is the weighted debt. And it's those two costs of capital are weighted. We also include a long-term growth rate if we're using a discount rate as opposed to cap rate. So then we're backing that out. So you're getting a weighted average cost of capital at 26.39, and then your cap rate, which takes out the long-term growth factor of 24.59. So the process is really kind of building this up from the ground up, call it from a risk-free rate, an equity risk premium, and then any other premiums that you need to add on with respect to the size or the industry or the company specifically. So this slide, I kind of talk, and we've kind of talked briefly about what those other risk premiums are that add to the discount rate, because the higher the discount rate, the lower the value. So that's why we call these premiums. And then as we get to company specific risk premiums, this is where it's a bit more subjective, as I said. So as we're assessing and valuing a company, we're going to look at, what the history of the earnings are, employee turnover. Maybe their forecasts seem a little bit too aggressive or too conservative. Customer concentration, is 60% of their revenue derived from one customer. Well, that's a risk item, and we have to address that in a company-specific risk premium. So we're building that into the discount rate, which is ultimately saying, here's our hurdle rate from a return perspective. So a quick sort of example that I'll walk through, and this approach we've used is the capitalized cash flow. So it's a stable business. We've got, a number of years of data and a budget. So we've kind of taken this, and I've kind of broken it down by line item to say, here's our pre-tax earnings, including the budget. Because we're looking at cash flows, we're backing out depreciation and amortization. We're taking out one-time items, so loss or gain on sale of fixed assets. That's a one-time sort of event, so we're backing that out, saying that's not really normal operations. Interest expense, because again, we're looking at EBITDA, so earnings before interest, taxes, depreciation, and amortization. Related party remuneration. So sometimes, in closely held companies, management will either sometimes pay themselves too much, like above market or below market. You're really sort of trying to assess what that is and normalizing what these pre-tax cash flows are. So we may adjust for those. And then if there are any other one-time costs like environmental cleanup or acquisition-related costs, like in this example, we'll pull those out. So we're saying normalized EBITDA, is in a range of, 5.2 million if you're looking at the average of 2023 and 24. If you're considering the budget as well, the high end is 5.8. So you're really kind of getting a high and low scenario here. And ultimately, you're going to work to a midpoint, but you're going to provide a range of value. So our next step is really kind of determining what that enterprise value is. So from our last slide, we've got the low and high normalized EBITDA that we've got. We're doing this on an after-tax basis. So we're deducting income taxes. And in this scenario, the tax rate is 28%. We're deducting sustaining CapEx. So obviously, if this business is going to continue, there'll be normal CapEx, investments and spend that will need to be made to maintain operations and continue to drive earnings growth. CapEx is a tax shield, so it will reduce the amount of taxes that you have to pay. So we're factoring that in. And then through our analysis, we said, well, the business needs a bit of an adjustment to working capital. So we've adjusted that there. So we've really come down to what that normalized discretionary cash flow is. After we take that one-time items, we've assessed, here's what the company needs from a CapEx perspective, from a sustaining CapEx perspective. And then because we're doing a capitalized cash flow, we have 1-point estimate. We're using a cap rate, which is really, it's a discount rate, but it's a reciprocal of the discount rate. We'll give you a multiple. So that would equal our capitalized cash flow. So 25.6 to 26.9. Abu, question?
Yeah, I have a question on the cap rate. So how did we determine it was 12% or 13%? Yeah, I see you have a multiples of 8 or 7. So the multiples, is that determined? How is that determined?
So so we determined the cap rate by using our build-up approach for like what we did for WACC. And we just said 1 divided by that cap rate gives you a multiple. So rather than 12 or 13% here, we could say 3 million times 8.3 or 3.5 million times 7.69. So it's a reciprocal of the discount rate. It's just some people will want to see, hey, well, what's the multiple as opposed to what that discount rate is. But you can always work it back and forth and understand what that discount rate is. And then what we've also done here is we've said, you know, the company already has an asset base, and there are tax benefits from that as well, because there'll be depreciation charges that will reduce the amount of taxes. So we've calculated what that is. So our overall enterprise value is between 26.4 million to 27 point, call it 8 million. This is our high-low range. To get to our equity value, we've taken that enterprise value, we've deducted our debt, we've added what, you know, we talked about earlier about redundant assets. We've said, well, there's some excess cash based on the analysis that we've done, some excess cash that's not really required as part of the company's operations. We've said, you know, there's also some, you know, redundant assets. So the company may have loaned money to a shareholder or a related party. We're factoring that in. In the budget, I believe we had a one-time environmental cleanup that we were expecting. So we've taken that into consideration. And then also the tax impact of that, because although we're going to have an expense of 400,000, we're going to reduce our tax bill by 112, so the 28%. So that is, when you take those items out, it's giving you an en bloc, which is in total 100% of the equity value of the company of 23.8 to 25.2 million, call it. And so here's where my asset approach comes in to say, well, of this 23 to 25 million, how much is the implied goodwill or intangible value in here? So the value of the company's operations, or the equity, at 23.8 million. And when I went through the balance sheet and determined what the fair value of those net tangible assets are, it was 8.6 million. So I'm saying there's an implied intangible value or implied goodwill of about 15.1 to 16.5 million. So that could, you know, I could go through a separate exercise and say, well, what makes that up? Is 10 million of it brand and 1 million workforce and 1 million software, or a combination of those? That's sort of the exercise that we do when we're doing a purchase price allocation, where we've got to break down each one of those components. But this essentially gives you, you know, here's the goodwill. If we were to purchase this company, here's the implied goodwill over any tangible assets that we have. So that's really kind of the step-by-step exercise. I know I went through this quickly because we're running out of time, but
Yeah, thank you.
but that's you know, a fairly comprehensive capitalized cash flow example.
Okay, thank you, Vince. Let me open it up before I kind of give my final thoughts. So, Alex, Joel, any questions, any commentary from the both of you?
No, this has been good, a good refresher. You know, I never worked in M&A or investment banking, so, you know, it's not something I really used in the workplace, but certainly getting a refresher on all the concepts and everything, and thinking a little bit differently about things, because corporate finance is all about valuation. That's basically what it comes down to.
Yeah.
So this is a great exercise, a great refresher and overview. Thanks.
Thank you very much.
Yeah, thank you. I see Joel had a comment. Good presentation. Vince,
Yeah,
you know,
thank you, Joel. Appreciate it.
I always enjoy these conversations with you. I mean, I don't know anything about this stuff, but you know, I love I love numbers. I love going through numbers. I'm math challenged, but I love going through these scenarios and just trying to, you know, just trying to go through these examples, because you know, in life I've seen these things happen cursory to the work that I do. So it's always interesting to get the analytical as opposed to the qualitative, which is kind of the side that I tend to err on. So thank you again. The second side for coming in.
Yeah, I
sharing
greatly
yours.
appreciate it. I always look forward to these. Thank you.
Yeah, thank you again. I'm sure folks will have questions. Vince's information is there as well. If you, I'm sure folks would not mind having these slides as a takeaway. If you
Absolutely, I'll get that
kindly,
to you.
absolutely, absolutely. Thank you so much, Vince, again for gracing us with your presence.
Great, thank you for having me, and I really appreciate it. Excellent questions and discussion. Alex, Jewel, Abu, really appreciate your time. Thank you for having
All
me.
right, thanks. Yeah, thanks
Thanks
so much.
again. Take
Thank
care.
you.
Have a good evening. All
You
All right.
too. Take care.
right.
Ciao.
Take care.
Bye.
Bye-bye.
Okay, bye.